Hello guys, now that we are almost at the end of the year, soon the tax season is gonna start and I want you guys to be ready for the tax season. If you are new to investing or have been doing it for few years, you may very well underestimate the impact taxes can make on your gains that you have earned throughout the year. IRS can take a lot of cut out of your profit if you are not careful in managing your profit and losses. It feels very nice when you make that big profit, but when it comes to taxes, IRS can take a big chunk out of your pocket. And in this video, I'm going to give you some key points that you have to keep in mind to avoid heavy taxes on your gains that you have make throughout the year. So without further ado, let's start. Hello guys, welcome to another video, and this is probably going to be my first video on taxes, but I am planning to make a series of these videos to explain you, because it is not possible to explain all the tips and tricks around taxes or how you can save taxes in one video. So I'm going to break it down and start with the basics, and then I'll go to more complex scenarios, because taxes, as you know, can become really complex depending on your situation. But based on my learning, which I probably have learned the hard way, and I have paid a lot of money to IRS, but over the years I have kind of gained on how you can save taxes, whether you are a long-term investor, a trader, or a swing trader. In all those ways, there are ways in which you can save a lot of money in taxes, and in this series I'm going to explain all the tricks that I have learned over the years. Okay, before we dig further, let's clear up some basic tax terms that you should be knowing if you want to understand the whole IRS system or how it works, especially in terms of the stock gains that you have made. So the first one is what exactly is capital gain tax, right? So capital gain taxes are a type of tax on the profit that you get by selling asset. It could be a stock or real estate or business or any kind of investment, right? So by the profit that you gain out of selling them, the taxes that applies on that kind of gain is called a capital gain tax, right? So your stock profit comes under this umbrella of capital gain taxes. In simple terms, capital gain tax is calculated by taking the total sale price of that stock and deducting the original cost basis, right? So for an example, you buy something for $100 and then you sell it for $200. Whatever you made, right? You made $100. That is the capital gain tax that you have to pay on that profit. Now, how much capital gain tax you will be paying depends largely on these three factors. It's first is how long you have owned that stock. The second is primarily the income tax bracket that you are in, because for different individuals the brackets could be different, which we are going to discuss in more detail in later part of this video. And the third one is your marital status, right? That is one major factor in determining your taxes. Okay, moving on to the second part, right, which is realized gain versus unrealized gain. You may have heard these terms about realized gain and unrealized gain. Let's understand with this example, right? Let's say you buy 100 shares of a stock at $10 each, right? So you made $1,000 investment, right? That is your capital investment. Now let's say after 6 months that share has increased by $5. So now the new value of that stock is $15. So your total capital now is 1,500, right? So you have made the $500 profit on it, right? So that $500 profit is still a unrealized gain, right? Now that let's say you decide to sell it. So as soon as you sell those stocks, right, you are going to make that $500 profit. Now that profit is called your realized gain, right? And that is taxable. IRS does not tax you on your unrealized gain. Let's say if you hold a stock for 5 year, 10 year, right, and you gain multifold on that stock, IRS will not tax you on that until and unless you sell it. Okay, now that we are clear on those basic things, let's understand a very important concept about short term versus long term. There is a short term capital gain and a long term capital gain, right? And how IRS defines them is, if you buy and sell a stock within a year or less than a year, then that gain comes under short term capital gain tax umbrella. However, if you buy something now and then sell it after a year or maybe more than a year, then that comes under the umbrella of long term capital gain tax, right? And the tax rates are widely different. The short term capital gains are taxed heavily by IRS versus the long term capital gain tax. They are taxed at a flat kind of slabs, right? So short term capital gain taxes are taxed at your ordinary income level, which we are going to discuss both the charts. And the long term capital gain tax have this just three slabs: 0%, 15%, and 20%. So this is the slab of ordinary income of 2023, right? This is how it looks for your ordinary income. And remember, the short-term capital gain tax would be taxed at these tax slabs, right? So let's say if you fall into something like if you're married and filing jointly, you may fall in this 89,451 to 190, right? If you fall in this bracket, then your tax rate is gonna be 22%. Now compare that to the long-term capital gain tax, right? So for the same amount, let's say you fall in the same bracket, right, of 89,000 somewhere this range, right? Then your tax rate becomes only 15%, right? And also look at this, right? If you are married filing jointly and your total income is less than 89,250, you pay 0% tax on your capital gain, right? So that is huge difference when you compare to your short-term capital gain taxes, right? In short-term capital gain tax is taxed at your ordinary income level. So as your income increases, that's gonna add up and further increase your income taxes. If that sounds a little complex, don't worry, let me explain you with a quick and very simple example, right? Let's say you bought $5,000 of stock in January of this year, and now then you sell it anytime like before December for let's say $6,000, right? So you made a total gain of $1,000. And remember, because you sold within a year, those $1,000 gain that you made, that comes under short-term capital gain tax. And if your income is remember what we discussed is between that 89,000 to 190 kind of range, you are gonna be taxed at 22% on that $1,000. That means IRS is gonna take $220 out of that $1,000 profit from you when you file your taxes. Okay, now let's compare that with the long term, right? So let's say instead of selling in December, you hold it for another 2 months, right? And you sell it anytime next year, like you sell it on January or anytime after January, right? Now your taxes would be much less, right? Now let's say if you in the same kind of income range, your taxes now would be 15%. So you are gonna pay only $150 in taxes. And also if your income is below that $89,000, then you are gonna pay $0 to taxes to IRS for your $1,000 gain. So as you can see, by holding just a little longer, you're gonna save a lot of money in your taxes. And this is a mistake that a lot of beginner investors make. They do not account for taxes when they buy and sell stock. So instead of doing this short-term capital gain tax, it's good to always plan for at least holding a stock for a year. And if you are anyway doing a swing trading, at least hold for a year so that you save big on your taxes, right? So instead of giving to IRS, that money is gonna come to you. So if you have anything, any stock that you are planning to sell now, just and you bought it somewhere beginning of this year, then just hold it for a couple of more months and then sell it next year in January. You're gonna save a lot in taxes. Okay, so let's summarize whatever we discussed, right, for this video. So the one key point I wanna take home from here is if you are holding something, then hold it for at least a year. Do not pay short-term capital taxes to IRS. That is the key point in this. There are other things that I'm going to discuss in my next video, which is about if you are doing a lot of swing trading or day trading within a year, how you're gonna save in that scenario, right? So there are some, you definitely would have some losses, right? So losses are your friend when it comes to taxes. So those losses you can actually offset against your gain, but there are some key points there as well that you need to remember, and which we are going to discuss in my next video. So please guys, if you have not subscribed, do subscribe. I'm gonna discuss a lot more detail about taxes in coming months, so do subscribe. Okay guys, I'm gonna cut short this video for now, and then we are going to continue our tax discussion in my next video. Happy investing guys, and I'll talk to you in my next video. Bye bye.